Bonjour et merci de prendre le temps de regarder ce deuxième épisode de la série sur la transition CDOR, produite par le Groupe de travail sur le taux de référence complémentaire pour le marché canadien, que l'on surnomme le TARCOM, en collaboration avec le groupe TMX. Je suis Élodie Fleury, directrice générale gestion des changements réglementaires à la Banque Nationale Marchés financiers, et je co-préside le sous-groupe Rayonnement et communication du TARCOM. Notre mandat consiste à informer et éduquer les participants de marché et le public en général sur les deux étapes de la transition du CEDOR au CORRA et à collaborer étroitement avec les autres sous-groupes du TARCOM pour articuler un message consensuel clair. Nous espérons que cette série de vidéos atteindra ces deux objectifs et aidera les participants de marché à réaliser une transition ordonnée et éclairée du taux de référence sensible au crédit bancaire canadien, qui est le CEDOR, taux CEDOR, vers le taux de référence sans risque canadien, qui est le CORRA. La première vidéo de la série, mise en ligne le 31 janvier, visait à vous donner un portrait global de la transition, son historique et son calendrier de jalons importants à haut niveau. Nous souhaitons maintenant apporter une lumière plus particulière sur chacun des grands volets de la transition, à commencer par cette vidéo qui traite de la transition des dérivés de taux canadiens à CORRA. Un panel d'experts de l'industrie a été réuni pour vous livrer les tenants et aboutissants de cette thématique, avec pour modérateur Robin Das de la Banque royale du Canada, qui co-préside le sous-groupe des dérivés du TARCOM. Le sous-groupe des dérivés du TARCOM, co-présidé par Robin et par Alison Perdue de la TD, est composé de représentants des secteurs publics et privés, bancaires, institutionnels et corporatifs, et de la Banque centrale du Canada. Son mandat consiste à aider l'industrie à identifier, évaluer et relever les défis reliés à l'abandon du taux CDOR dans les produits dérivés. Autant les dérivés de gré à gré, compensés ou bilatéraux, linéaires et non linéaires, swap de devises variables-variables, que les dérivés listés. Je vais maintenant céder la parole à Robin et ses invités pour qu'ils nous présentent leurs réflexions sur les enjeux et opportunités de cette transition.
Hello, I'm Robin Das, Managing Director and Head of Canadian Interest Rate Derivative Trading at RBC Capital Markets and the co-chair of CORRA's Derivatives Subcommittee. Today, I'll be chairing a panel on the CDOR to CORRA transition. Joining me on that panel are Marc Laberge, the Head Trader, Portfolio Manager for Rates and FX Derivatives at Desjardins, Jean-Philippe Dumont, Trader and Portfolio Manager for Fixed Income at CDPQ, Chris Miller, Head of Interest Rate and Credit Trading, Fixed Income Commodities Currencies at National Bank of Canada, and Tim Soroka, Managing Director and Head of Canadian Interest Rate Derivatives Trading at TD Securities. The timing of this panel is very apropos, as we've just switched from CDOR to CORRA trading in the interbank market for CORRA first. Perhaps, Tim, I can call on you to give us your perspective on how that's gone so far.
Yeah, sure. I think the shift to CORRA trading interbank was almost instantaneous on Monday when it kicked off. The CORRA First initiative was taken very seriously by, I think, the dealer side and the market makers, and made a strong effort to make sure that core prices were being reflected in the broker market. And I think we also had the advantage of seeing the SOFR market evolve and seeing the kickoff to that, the LIBOR SOFR transition. So we do have a lot more experience going into this move. I think it caught a lot of the clients by surprise, just because a lot of them either weren't prepared or were just expecting that CDOR would be more dominant over at least the month of January and would kind of transition a little bit further on. So the fact of the matter is, a lot of the client flow that we have seen has been versus CDOR, and it's become a little bit more difficult, or just being more of a balancing act for market makers to balance the liquidity being shifting to CORRA in the interbank market, while client flow is still a little bit more CDOR based. So especially with swapped issuance being very topical this week, we're starting to see that where liquidity in CDOR will start to slowly decrease over time. And I think it's one of these things that so far at least on the market maker and the dealer side, we made a very strong effort to make sure that CORRA first is taken seriously. And I think a lot of that liquidity is being reflected, at least in the 5 to 30 year sector at first for CORRA. And I do think the harder thing that will be a little bit slower to evolve is the front end, where some of these trades that straddle the cessation date or curve trades, those are a little more difficult, and the back's liquidity is still there for a lot of these counterparts. So for them, they'll be a little bit more patient, but I do think that at least from my perspective in the interbank market, it's been a great success.
I would agree with you. And I think some of the issues that you talked about interbank liquidity being primarily CORRA and a lot of the client activity still being dependent on CDOR is not too unexpected. It's quite similar to what we saw with the LIBOR to SOFR transition. And perhaps we can get a client's perspective on that as well. Mark, how did you see it?
Well, I must say we were, as a firm, very supportive of the CORRA First initiative. We want to be first movers to support it, and we have been very pleasantly surprised of the liquidity we've been having, mostly the difference in liquidity prior to CORRA First and after CORRA First for swaps over the terms of 2 years, which are mostly traded in CORRA swap spread versus the old classic CDOR swap spread. This has been very meaningful. All the runs have been switched. The liquidity is there. We've traded actively since the beginning, since Jan 9 on CORRA swap spread, so it's been going very well. Under 2 years, we were expecting less of a dent from the CORRA First initiative because there was already activity in the CORRA space, in the OIS space, significant activity. And like Tim has mentioned, let's say under a year and a half, we're still under the June 2024 the June 2024 deadline, which is still expected to have CDOR move and have CDOR risk being traded. So our focus on CORRA First success, let's just say, was focused on the 2 year and over, and we feel it's been great liquidity. Under 10 year, we've tested mostly. We will test out further out the curve in the coming weeks and months.
Thank you, Mark. Jean-Philippe, would you agree with what Mark has said?
Yes, I agreed. I agree, and I would add maybe more generally to all those dates. I think CORRA First is a very good initiative because, like we observe in the US and in UK transition, the market won't switch to the new risk-free benchmark rate until that is incentivized and forced to do so at a cutoff date. So the incentive for Canada will be the CORRA First dates, and the mandatory aspect will come on June 30th to 23, where no new CDOR risk should be traded after this date. But let's take a step back and put this whole transition into perspective. For a lot of market participants, the very important gain of having a more robust and representative reference rate for the market is an abstract concept attached to lots of observable IT budget for system developments, and lots of time spent to manage and execute the switch from IBORs to risk-free rates in cash assets and in derivatives. So it's a significant undertaking for what in principle appears as a singular change. In the end, market participants will still transact interest rate swaps, cross-currency swaps, swaptions, but it's just going to be on a new reference rate. To be clear, I think this transition is essential, but it's understandable that many market participants will not switch to the new risk-free rates voluntarily, and that they should be incentivized and eventually forced to do so at a certain cutoff date, which is why I think all those dates are very, very important for the CDOR transition. The CORRA First dates will be enough for most institutional players to switch to CORRA trading, like Marc Laberge just mentioned. They are already trading CORRA in the market, but I think the bulk of the market will make the switch on June 30th for sure of this year, and that's when the volume will significantly pick up in the CORRA market.
Thank you very much, Jean-Philippe. Chris, do you have anything to add on this, or to me?
Oh, maybe just a quick point, where we go from here. Tim referenced having the SOFR market as a guide, and, there we went from SOFR trading less than 10% to over 50% of the overall risk, roughly 6 months after the SOFR first date. And I think the argument can be made that CORRA First was designed, with an even faster big bang in mind to try to prevent a sustained period of bifurcated liquidity. Additionally, SOFR represented a new market, whereas we've been trading CORRA derivatives, for 20 years in Canada. So bottom line is that I think we can have the expectation that liquidity, transition will accelerate fairly rapidly.
I would agree with that, and that brings us to one of the points that Jean-Philippe brought up about the June 30th deadline for no new CDOR trades unless they're risk reducing. That does bring some concerns of how liquidity in CDOR swaps will evolve after that. Perhaps Tim, can you give your thoughts on that?
Yeah, the fact of the matter is CDOR swaps will be on people's books for longer than the June 23 date, and there'll be a lot of unwinds to be processed. But I think that date is a very key point to catch the liquidity in the transition. I think if you're trading it from a market maker's perspective, if we're putting prices on people transitioning to CORRA swaps, at some point you're going to be taking on CDOR swaps and the reset risk applied with those swaps and not being able to hedge it in the interbank market. We won't be able to do as many, any sort of CDOR-based swap to hedge that reset profile, and you're going to have to hold it and be comfortable with it. So I think that becomes very important as we pass that date. Sure, you can do unwinds, but there will be a liquidity premium for that. I think talking to a lot of these accounts that trade IMM dates, they're using that kind of March to June roll as a window that they kind of soft circle, and they're trying to get feedback, but I think that's kind of been the guidance where they feel they want to switch over to CORRA swaps. So I think there is that pocket of liquidity available probably in that early March or the month of March to transition over. And once you get past June, it's just going to become more and more difficult to accommodate that. So I think it just has to be on people's radars and make it a priority and not get too complacent in transitioning some of this risk over to CORRA.
I would agree, and I think the March timeframe that you're highlighting, it makes a lot of sense. First of all, because of the IMM role, but also because March 27th is also the transition date in the interbank for nonlinear and cross-currency derivatives as well. So you have a added incentive for people to move away from CDOR-based derivatives to CORRA. Mark, from a client's perspective, would you think that the time frame that Tim has put out would be appropriate or applicable?
Absolutely, I totally agree with Tim here. I think we need to know that, like Jean-Philippe was saying earlier, institutional clients will be the quickest to switch to CORRA-based RFQs or quotes asked from dealers. And the date you mentioned on March 27th for me is key. We saw in the U.S. that the adoption of SOFR-based cross-currency was even faster than the OTC derivatives. Was within a few weeks it seemed to switch. So we're hoping this happens in Canada as well. We've been already transacting CORRA, SOFR CORRA cross currencies recently, and it's been a very good experience. However, that being said, totally understand that the range of players, some will have more challenging times of switching, and I feel there's a sweet spot where people who are ready will be able to trade out of CDOR risk, their legacy risk, and come out of it. But those who choose to wait or do the fallback process, which we'll talk in the next point in the legacy portfolios, there's a sweet spot where if you don't trade it out, you're going to be losing CDOR liquidity fast in 2024, and you might not get the chance to trade out of it for your old risk. So I do expect CDOR liquidity to fall pretty quickly after the June 2023, but still stay there at a let's say 15 to 20% level. We feel even if we're very core first focused, we still feel we'll have maybe 5 to 10% of CDOR risk being traded for unwinding specific activities.
Thanks, Mark. Chris, you made a point on the CORRA First initiative that it's accelerating quicker than perhaps SOFR first or some of the other IBOR to RFR transitions. Do you see that happening by the June 30th date of this year?
Yeah, I would agree with pretty much everything that's been said in terms of the timing. I think that yeah, March is obviously a critical date. I think things will accelerate really quickly, and I think that the market will look rapidly different by June. I mean, that holds true for the OTC market, and I think that will also hold true for transitioning the liquidity from the BAX market to the CORRA futures as well.
I think that the June timeframe is also quite critical. One, because of the CORRA's requirement or recommendation for no new CDOR risk, but also because in the US, LIBOR goes away, so all trading there will move to RFR or to SOFR. And I think that's going to be a very key point for international and multinational firms, particularly. They want to be trading apples to apples. So if they're trading RFR in dollars and sterling, they'll be looking to trade in RFR in Canada as well. Jean-Philippe, as one of those multinational trading firms, would you agree?
Yeah, I would agree. Maybe I would add, because it was clearly mentioned that the volume on CDOR will naturally reduce past June 30th to 23 date. But I would maybe add one point that I think is good for the switch from CDOR liquidity to CORRA, is that lots of market participants are agnostic of the reference rates and wants to express market positions either for speculation or an edge with the least transaction cost possible. So if the most liquid curve is now CORRA, since CORRA first is switching CDOR liquidity to CORRA liquidity, they will naturally switch to this new curve, which is positive for CORRA liquidity, but negative for CDOR liquidity.
Yeah, I would agree. And I think the fact that they've already seen this happen in other jurisdictions makes people much more comfortable with moving. And one thing that happens when you move from IBOR to RFR, or in this case CDOR to CORRA, is that there will be an impact on people needing to change or transfer their legacy portfolios. Mark, perhaps I can ask you to talk about that.
Yes, of course. This is a very key point. There's I think one main thing to understand is that there's two main ways of switching your portfolio. You can trade out of it, which is basically closing CDOR swap and opening CORRA swaps with this similar specifications. And this, I think, the sweet spot, we seem to agree, everyone on this call, is going to be Q2 2023, when CORRA liquidity is up to a very interesting level, but CDOR liquidity has not fallen off a cliff. However, for clients or participants who feel they're more comfortable with going to the fallback process, this fallback process will happen in June 2024, and your trades will be converted automatically. However, there is a very, very important aspect to going through the fallback process, is the fact that, of course, you need to have the specific docs in place, which means the ISDA fallback protocol, or having an ISDA under ISDA 2021 definitions. And also remember that there's been a lot of discussions on the transition internationally, having an objective of minimal P&L impact. This is true, but it is only true under very specific criteria, which is the minimum P&L impact will happen on cash flows which are after the June 2024 cessation date, with the ISBA fallback spreads being fixed. For those who want more information, there is information both on the CORRA website and on the ISDA website on this fallback process. So if you have the right documentation, you can go through this process. However, it is valid only for cash flows after June 2024. Any cash flow prior to that will be subject to market levels. So if you trade, let's say, out of your CDOR risk into CORRA risk in June 2023, you need to know that you have 1 year of market risk and 1 year of fixed spreads for the cash flows after June 2024. So you need to have your right legal framework in place, and you need to decide if you want to trade out of it or go to the fallback process. And of course, as a treasury, the edge accounting aspects of doing these decisions is very, very important, and the minimal P&L impact is very important. It's the same for different types of clients. Edge accounting can be a main decider. So please do make sure that you check all the right boxes and have right counsel to help you go through that, and make sure you don't get breaks in any accounting process you need to have.
Thank you, Mark. I think you made a very good point that there is still open CDOR risk between now and the end of June of next year. And that could potentially see people wait a little bit longer to transition away from CDOR to CORRA. And I think we've seen that in the US as well, that the big divergence between where LIBOR SOFR is actually trading and the pullback rate is causing some people to wait longer rather than transition earlier. Hopefully, perhaps you think that'll be a criteria that will determine whether clients switch sooner or later to CORRA swaps from CDOR.
Yeah, I think it's a criteria, but I think what will be the most important criteria will be the liquidity in the market. I think for most of the risk in portfolio, because based on what I observed in other market and based on the simple fact mentioned in the previous question, where the volume on CDOR will naturally reduce past the June 30th, 2023 date. I think between Q2 and Q3 to 23 represents an ideal window to switch on the 3 months before the June 30th date and 3 months after. And I think that's where the volume will be good in both markets, and that would allow the bulk of the risk to be transitioned with the least transaction cost as possible. I think that's a very important factor there. I think by Q2 to 24, dealers could be, so I don't recommend waiting that long, because if by Q2 to 24, I think dealers could be pickier on what they'll price. If the client asks a quote on something that will add to what's left of the bank's CDOR portfolio, some could politely say that they prefer not quoting or shadow price or just price to lose, which can represent a higher conversion cost for the client. So I think the liquidity is the very important aspect that will determine, at least for the bulk of the risk in the market, to switch with the least transaction cost possible.
It's a good point that JP made, that liquidity will be drying up as we get closer and closer to the cessation date. And we're seeing that in sterling, and we're starting to see that in the US transition. How would you, as an institutional market maker, have that impact you, or what would you do to try and minimize that impact?
Yeah, I guess I did want to, sort of come back on the conversation here to some extent. I do agree with many of the points that Tim made about, how a risk buildup of reset risk will, complicate the ability for dealers to facilitate these trades. But even, with most trades happening in CORRA, our expectation is that CDOR derivatives, will remain relatively liquid, until its cessation. So I want to be clear that I think what we're really talking about is an optimal point, but I don't think that there needs to be an extreme panic. Our expectation is that the fallback provision will keep a, relatively tight arbitrage relationship between those, two markets intact, really right up to, the point of cessation. So I think, in what we were talking about, there's many ways to, transition that legacy portfolio. And I think, working out of your CDOR OAS risk and then coming back to your bilateral counterparties, to ultimately unwind it, is one of the safest ways to do it. And I think you want to, afford yourself more time to facilitate working the FRA OAS leg over an extended period of time in case the market doesn't permit that liquidity.
We talked about the success of the CORRA first transition and the impact or potential impact on CDOR liquidity going forward and the resulting impact on legacy portfolios. Is there anything else that anyone would like to share to market participants watching or anyone else in the audience? Perhaps, Mark, I could start with you.
Yes, thank you, Robin. So there's two main items I think market participants need to be cognizant of, especially in the corporate sector and the commercial sector. We're aware of this, of course, because of the U.S. experience, and as a lender, we've seen clients experience some challenges through that experience. One is the fallback language synchronization between products. So just for example, we might think that the fallback languages for loans and for swaps are all been naturally matching and will provide cash flow matching post June 2024. It is actually not the case, and it's not a mistake. It's by design. Each product's fallback language was designed with the majority of their end users in mind. For example, the loan market has 15 to 20% of its floating loans edged by derivatives. So 80 plus didn't need any derivatives linked to their fallback. So the fallback language is not perfectly matched with derivatives. And the same thing for derivatives. There's a lot of institutional players and that don't have a loan market attached to their loan attached to their derivatives. We might even estimate up over 95% of derivatives end users don't have a floating loan edge with that. Same with other cash instruments. So please be very cognizant that you need to revise your fallback language and maybe modify one leg of your fallback language to make sure they match if you want to go through the fallback process. If you want to trade out of your risk, it's not something that's it's a huge risk, but something that could be used more as a fallback scenario, to use the same word, as a plan B. The second item I would talk about is the recent announcement that there's going to be a term CORRA rate being created, and a term, let's say, similar to term SOFR in the US. It might be confusing for some market participants to differentiate that with the Core First initiative, which is focused 100% on the daily CORRA swap market. One thing we can say is that this term core market, there is going to be derivatives associated with it, but the expectation is that it's going to be less than 5% of volume, even lower. The main CORRA reform initiative, CORRA to CORRA reform initiative, is focused on daily CORRA. And please note that the whole fallback process and all legacy portfolios will fall back under ISDA fallback protocols to the daily CORRA as well. So term CORRA is there to accommodate clients who need it, but the main liquidity will stay within daily CORRA. And finally, there is the expectation, similar to the US, that clients hedging with term CORRA derivatives, if they need it, could see higher hedging costs than if they were using an overnight CORRA, a more liquid market, and the most prevalent hedge instrument in the market.
Thank you, Mark. Jean-Philippe, having gone through this in sterling and now going through the US dollar RFR transition, is there anything that you'd like to add for Canada?
Yes, for sure. I would say there are three actions to consider. I think the first one will resonate more with people or market participants that are more involved in private debt, and the third one is more derivatives based. With the first one, for those active in private debt, I suggest you list all the floating private cash asset referencing CDOR, because converting cash product to the new risk-free rate is a lot more time consuming than it is for a derivative. You have to amend and renegotiate each contract individually. The second, again, for private debt, I suggest you be ready to negotiate, because the conversion process is often used by borrowers as an opportunity to stealthily tighten the credit spread by demanding a lower CSA or credit spread adjustment in a contract. And so it's a very important aspect to keep in mind. Finally, and I think most importantly, in terms of derivatives, if the nature of your activity, if your firm has the flexibility, or if your mandate allows you the flexibility to proactively switch to CORRA, I don't suggest you keep a CDOR-based product after June 30th of 2024 that will fall in the CDOR fallback. The reason why I stress this is if it is already demanding for you to develop your system to handle the new reference rate, keeping a CDOR-based product after the discontinuation date will force you to handle and maintain different sorts of index, curves, so the daily CORRA, term CORRA, and different forms of fallback CDOR. So it's a little more work before the discontinuation, but the book will be cleaner and simpler after. And if you consider the long-term benefit and wish to avoid having to manage more operational complexity after June 30th to 24, I think it's better to just rip out the Band-Aid quickly and get over with.
Thank you, Jean-Philippe. Chris, from a capital markets trading perspective, is there anything you'd like to add?
Sure. Well, I think Mark and JP definitely touched on some of the most important points there. So maybe I'll just end with a call to action. I would say the architects of the Canadian risk-free rate reform have really aimed to balance providing market participants the time they need to transition with the acknowledgement that the Canadian market lacks the liquidity to sustain a prolonged period of liquidity bifurcation. So the truth is, we really need a fast shift into CORRA to ensure a robust and well-functioning market, and it's incumbent upon us as market participants to make sure this happens. So, we really implore investors to proactively make the switch to CORRA products as soon as they're able and as soon as it's economically efficient to do so.
I would agree. Tim, would you add anything before we go?
Yeah, I would just add that, it's up to the clients to reach out to us and keep in communication with the dealers to ensure they don't miss that window of opportunity to roll over their positions. I think there's no exact answer to when that pocket of liquidity will exist. I think every client has to adhere to their own internal policies on when they're going to convert to CORRA and whether their systems are ready to handle it. So I think it can move very quickly. So keep the dialogue coming. And then lastly, I think I would just say that with CORRA, like pretty much as you take new trades as a client in CORRA and you get more comfortable with it, like Mark said, start testing out some trades, start testing out some CORRA SOFR trades, test out CORRA, see how it flows into the system so that any new risk you're taking is in that product and you're comfortable with the levels that are being shown and how it trades in the market, so that when the time does come and you get the signal that you're going to convert your portfolio, that you're prepared for it and it's very smooth and seamless on the client side. So that's the only thing on my end.
Yeah, thank you, Tim. I would agree. And I think one other thing I would say is to go along with what Chris said is don't leave it to the last minute. I think you want to be proactive and well ahead of the actual transition date on June 30th of 2024. There's lots of information about this on the CORRA websites and for cleared swaps on the clearinghouse websites. So, and certainly anyone watching this, you can reach out to your CORRA members or dealers that you or dealing counterparties that you have derivatives with, and I'm sure we'll all be very willing to help you. And on that note, I would like to thank all of you for watching. I'd like to thank my fellow panelists, and I'd also like to thank the TMX for hosting.
Merci d'avoir visionné cette vidéo. Nous espérons que vous avez apprécié entendre les perspectives de nos experts concernant la transition des dérivés sur taux canadiens. Quelques points clés sur lesquels nous tenons à insister en conclusion de cette discussion. Premièrement, les 2 étapes de l'abandon du CEDAR. À partir de la fin juin 2023, CEDAR ne sera plus transigé dans les dérivés, sauf pour couvrir ou réduire des expositions CEDAR préexistantes sur dérivés ou titres, ou encore pour couvrir des prêts sur CEDAR, lesquels pourront continuer d'être conclus après juin 2023. Nous pouvons prédire d'ores et déjà que la liquidité sur les dérivés CEDAR va diminuer de façon significative, alors que celle sur les dérivés CORRA va croître entre juin 2023 et la date d'abandon définitif du CEDAR, 1 an plus tard, le 28 juin 2024. D'autres jalons importants à prendre en considération sont les 2 dates effectives d'initiative visant à privilégier l'adoption du CORRA sur le marché intercourtier, communément appelé CORRA First, dont l'une vient de passer le 9 janvier 2023 pour les dérivés linéaires et le 27 mars 2023 pour les dérivés non linéaires et les swaps de devises variables-variables. C'est aussi à partir de ce moment qu'on devrait commencer à voir les clients à commencer par les investisseurs institutionnels, migrer leurs dérivés progressivement vers CORRA au fur et à mesure que la liquidité bascule vers celui-ci, comme on a vu avec la transition LIBOR vers SOFR. Enfin, vous avez entendu nos experts s'entendre sur le fait que même si vos contrats de dérivés contiennent du langage de repli robuste, il peut s'avérer préférable pour vous et vos contreparties de procéder à la conversion vers CORRA de façon proactive plutôt que d'attendre à la dernière minute, au moment ultime et fatidique de la fin de publication du taux CEDAR. Merci encore pour votre attention et restez à l'affût des prochains épisodes de cette série. Le prochain portera sur la transition des titres au comptant. Ne ratez pas ça.